All right, welcome to another episode of Founders Club. Today we're going to be talking to Daniel Angel of Apex Real Estate Development Group. He's the managing partner there, and we're going to have a great conversation about building long-term wealth through real estate. And excited to have him on the show today. As always, make sure you guys check out the links in the description below. And if you like money and you like real estate, this is the show for you. Hit that like and subscribe button, and we'll see you on the inside. Welcome to Founders Club, the show for real estate entrepreneurs. Daniel, welcome to Founders Club.
Oliver, thank you so much for having me. Great to be here. Great to meet you. And hopefully we'll have a great conversation today.
Yeah, I'm excited. So obviously now you run a firm, real estate, multifamily focused, and you guys are growing and building your portfolio. I saw you guys are managing 360 plus units. So that's all very exciting. But before we get into all of the, what's working now and how you're finding deals and all that kind of stuff, why don't you tell us a little bit about just how you got started in the real estate game?
Yeah, of course. And thanks for that. I'll kind of like rail it back to, kind of like where I'm from, as well as my business partner. But, we were born and raised in Colombia, South America. Got to the States in early 2015 through a kind of like transfer from my corporate job at the time. I had a few experiences in the real estate world in Colombia, working for a couple of institutional investment funds down there. And my job at the time, once transferred to the US, had nothing to do with real estate. It was finance related, but I didn't want to get so much away from real estate and started doing some, fix and flips on the side. And slowly but surely started, to get some traction. So to answer your question, I would say, in 2015, started buying a couple of, distressed homes in Atlanta, learning, step by step, starting to get those, renovations in and some reps in. And then, trying to get, my experience or my back, experience to work. Got it, in a little bit more of a faster pace and getting some traction from there.
Nice. Very cool. So you moved from Colombia, you had another job, but real estate was kind of your side hustle. You start flipping some homes on the side, things like that. And then at what point did you like take it to the next level and decide like, I really want to do this?
Right. And that's a great question. I've always had kind of like an entrepreneurial mind, but it's one of those things where you're at corporate and you don't know when, how to do it. And then in 2016, I met my business partner. At the time, he was living in Miami doing something similar, but he didn't really vibe with Miami. Just told him, hey, this is what I'm doing in Atlanta. Why don't you check it out? And that was kind of like the moment where, once we started to put some pieces together and getting some more volume, saw that it was something we could scale. And then towards the end of 2016 was the moment when we were like, okay, let's think about how to scale it in more of a institutional way, at least, draw a timeline and put ourselves some, short-term, mid-term, long-term goals and pull the trigger on that.
Okay, so all right. So talk to me about that process of, I'm guessing you decided to go the fund route at that point, right? Where you're going to raise money to do bigger deals. And is that kind of the direction you took?
Exactly. So it was the fund route, but the idea was just to get a portfolio in place for rentals. So before that decision, we were still flipping homes and we were doing deal by deal. We did raise some equity, but deal by deal, home by home. And this was, back in 2016. So just to give it some numbers, and here in Atlanta, so we were getting homes at, call it $50,000-$60,000, putting in maybe another $50,000, and then selling at high hundreds pretty much. And then the name of the game at that point was just getting scale. We got to a point where we were doing 18 to 20 flips at a time. I guess like in the cycle, and then just churning. The problem with flipping though, and at that time, was every time we sold, it was okay, let's do it again. And then you were dependent on if you were going to find enough inventory where numbers worked out. And then
Right.
you get into the game of, if the market is overheated, then you have a lag. If it's a buyer's market, then fine, but then you have to raise faster. If you raise too fast, then you can't deploy. You know perfectly what I'm talking about.
Yeah,
So at the time, we were like, okay, let's raise funds for rental properties also. Then like the kind of like a burst strategy. We did that. So we raised a couple of funds, and it was like two similar strategies. And one of the funds, it was only rentals ready for rent. So there was like no renovation risk. And then another fund that we had a mix. Some of the homes that we bought were ready to rent, and some of the homes needed some kind of fixing. For those folks or investors interested in a little bit more spice, obviously better returns projected, but a little bit more risk, whatnot. And that's how we started the fund game.
Okay, so it sounds like you kind of almost had two funds at the same time, maybe one a little less aggressive, lower risk, one with a little more risk and a little higher returns.
Exactly. That's exactly how we
Cool.
played that. That was still single family. So more than getting into larger deals, it was more like getting volume of what we knew, how to execute.
Your bread and butter properties.
Exactly.
Yeah. Okay. And then talk to me about how it grew from there.
Okay, so it gets to a point where you're doing a little bit of the same thing, which works. You can get scale, but then 2018-ish comes around. It's more like a seller's market. It's hard to get distressed properties or stuff where it really makes sense to buy. And we started learning more about multifamily. We saw that as a long-term play, something where we could kind of like graduate to. And, funny enough, I wasn't really looking for a job particularly, but I ended up having a chance to work for Cortland Partners. I don't know if you're familiar with them, but it's a large multifamily operator based in Atlanta. They invest in the Sun Belt and Southeast primarily,
Okay.
large operator, and it was like a great opportunity. So I decided to, work with them for a while we were doing our fund single family, I guess, like play, mainly to learn how to do it really, and to kind of like connect those dots between the single family world and the multifamily world.
Yeah.
I'd
And
say
learn
there's
from doing it from someone who's doing it at a really high level.
exactly. So in a way, it was kind of like taking a step back into corporate, but and I was transparent about it. It's like something I want to learn. I do bring, experience to the table, and fortunately enough, they gave me the opportunity to learn while I was doing, and just, added value, obviously, for a while, until I just thought it was time to, part ways again, and I guess take Apex to the next level. So with my business partner in late 2019, was a time when we were like, okay, let's, make sure we jot down everything that we're missing to get into the multifamily game, and let's, start working on it. Mid 2020, we managed to buy our first multifamily deal. It was kind of like a syndication structure. A lot of our existing investors jumped on this new venture, and we managed to to acquire that one, put in a Fannie Mae loan, and drove that renovation plan also.
That's great. So I want to get into that a little bit more about how you guys are doing deals and different value adds and things like that. Um, but what would you say is that the biggest takeaway that you took from that big company that is doing it at the higher level? What would you say is what you took away from that you applied to Apex?
Of course, I think a few things, but I would say like one, this company is owned by mainly by one individual. So and they're huge. They have like more than 200,000 units. I guess probably my number's stale at this point, but
Wow.
it's a matter of like if you really want it, you can do it, and that's something that fortunately we're in. I say the best country you can be in for that, and so it's kind of like learning that it's just a matter of wanting to do it and really meaning that you want it and putting the hours in to get it done. That was like
So
my
it's
main
almost like
takeaway.
it gave you the motivation you needed to just do it yourself.
Right. Totally.
Nice. Cool. Okay, so then you leave that other spot, you start working back on your own fund. Talk to me about what happens next, how you're finding deals, how you're raising money, or maybe we'll start with the deals, then we'll go to the money.
Of course. So we've been, even at, since inception, we've tried to be like really kind of like institutional minded in the way that we try to split our jobs or our roles, even since we started. So my business partner focuses on like lead generation, deal, kind of like sourcing, and everything that has to do like with the market today, asset management included. And what I do is everything that has to do with finance. So at the time, including corporate finance, capital markets, raising equity, raising debt, and all that stuff.
Yep.
So at the time, one of our points was like we need to start developing relationships with brokerage, both on the deal sourcing side as well as the equity and debt. So we started working on that, just getting ourselves out there, making sure we could develop relationships with people that would show us deals. At early stages, I mean, you can go, at least in our experience, you can go the off-market route. It's just tough because there's just, in our opinion, just a less percentage of probability or conversion rate. So we went the broker route, and it worked out for us.
And so when you say you went the broker route, is that mainly just finding all the big brokers in the area that sell a lot of properties and then building relationships with them and just letting them know you're a buyer and that when they have a deal to send it your way?
Exactly. That's exactly what we did. Just finding who were like the true players in the space that we wanted to play, defining your buy box. So in our case was like, okay, we're not big. We're not going to play into in the institutional route. It's just, be true to yourself, I guess, was kind of like our motto. And know, okay, we're going into the multifamily route. We want to get scale. We want to get to the institutional, but these are like the steps that we need to take. First off, let's get those relationships going, get at least the chance to see some deals and work it from there.
Right. Nice. Okay, cool. So it sounded like that started bearing fruit. You were starting to get some deal flow, looking at different deals. Um, Talk to me about how you set up the fund. Is it mainly syndications or is it a true fund? What's that
Right.
structure like?
Great
And how
question.
did you decide which one?
Right. So in multifamily, we decided to go the deal by deal route, syndication structure. So in that first case, we did a 506B. We just thought we had enough relationships, pre-existing relationships, to get that bucket filled up. And a lot of our investors at the time were probably not non-accredited. So we just wanted to make sure we had that chance to operate that way.
Gotcha.
We managed to find I guess, big enough deal to get into Fannie Mae and like agency debt, but small enough for us to be able to handle it. It was a 25 unit deal, North Atlanta, straight value add play, which was our like bread and butter. We have our own renovation team, so it was kind of like, right down the fairway.
Yeah. Yeah, and most definitely. And then in terms of, setting up the whole fund and everything, I'm assuming you just worked with attorneys on that and probably paid them a pretty penny to get everything dialed, which is definitely the recommended route. And then obviously deciding whether you're going after accredited investors or non-accredited, and then the attorney can help you figure out the best way to do the paperwork.
100%. And to your point, that's our suggestion. Just just make sure, anyone that wants to do it on their own, to get good advice and good counsel on that, get your documents and your, ducks in a row. Make sure
Yeah.
you're taking every step. It's going to cost for sure, but there's a lot of options out there for the syndication route. There's less than you would think in our experience, but there's enough people to help with that.
Yeah, no, definitely agree. Okay, so you've got your structure set up, you're getting deal flow coming in. Are you incentivizing those brokers? Are you like letting them in on these deals? Is that how you're doing it? Or is it just, hey, I'm a buyer, let's create a relationship type thing?
Oh, it's funny that you asked. We have never like incentivized them, but it's something that we've recently talked about, or I guess at least questioned ourselves if it's something that that helpful. It's been more like building the relationship and letting them know that we're a true buyers, that we're not messing around. In our experience with brokers, it's a matter of like be respectful of everyone's time. If it's something that you're actually pursuing, if you're able to underwrite quickly, give
Yeah.
feedback, make sure you're
And you got to be able to perform. That's the main thing they
and be
care
able to
about.
perform. For
Right.
us, that's the key. Like reputation, make sure anything you put under contract, you're closing. We have probably like never, unless it's the other side non-performing, we've never like pulled back from a deal.
Okay.
So, and that's really important. That's what's been kind of like our one of the main things to keep those relationships active.
Cool. All right, so you've got your fund put together, you've got the deal flow coming in. Now let's talk about how you're raising the money and funding these deals.
Of course. So one of the things that we brought from the single family space, we already had some pre-existing investors, and there's a lot of like word of mouth.
Right.
Some investors they did pretty well with us. They want to repeat. They have friends, family, and that's kind of like how it builds up. And then at the time, we had started working with family office. The reason I bring that up is just because usually check sizes are a little bit larger, so it makes it a little bit easier. So
Mm,
at the time, while we were buying that first multifamily deal, it wasn't our first, I guess, raise, because we had done our single family, I
right.
guess like different structures, so it was easier. And in our experience, it just get easier as you go. But here it was, calling up, following up, calling again, and
Right.
until we get to those commitments.
Yeah, it's interesting the way you did it because, by kind of scaling up like that, you already had the credibility, you had the base of investors. And the one thing about investors is once you do good for them and you help them make more money, they're going to refer their friends. And then pretty soon raising money is like no longer an issue.
Of course, yep, that's
And
that's
it
right.
sounds like you guys have found that out as well.
Of course. Obviously, as you scale, and one of the things that we've kind of like thought at least is, be cautious of how fast you want to go or you want to grow that next deal. Usually the next deal is going to be larger and the next one and the next one. The faster you scale, then probably the rougher it'll be for that equity raise, especially the equity. Debt's a little bit easier as long as numbers are there and the deal makes sense. That shouldn't be an issue. On the equity side, it's just like, make sure you're not too ahead of yourself.
Yeah, no, totally agree. And then on that note, is there a particular structure the way you put all your deals together, or is it different deal by deal in terms of how the investors are let into those deals?
Of course, no, we try to keep it the same and keep it simple. It's usually, we run on the GP side, we co-invest depending on the size of the deal and kind of like the deal itself, between 5 and 10% of the equity we will invest. The rest of the equity we raise from LP investors, and usually it's the one same bucket. We don't have different classes within the LP. In terms of like fees, we just have a one development fee at the beginning, and then a waterfall structure for the promote at the end, and that's it.
Cool. So you want your investors in for the long haul.
Yeah, of course. Yeah, that's definitely what we're looking for at this point. The multifamily that we're doing deal by deal, makes sense. It's easy, like in, sell, out, obviously after the whole period. But, in the future, we're obviously thinking about raising funds for multifamily also, which probably would be a larger check, especially with today's kind of like numbers.
Yep.
But, we want to take it one step at a time. We'll get there.
And what tips do you have on the raising money side, or what's kind of changed in your approach recently, maybe as well?
Okay. That's a good point. Our approach has changed a little bit just because we're starting to get more into the institutional world. So obviously we keep what we call like the retail route. We keep conversations with our existing investors, and whoever is, I guess, referred to us will do that. And obviously we reach out to that type of investor, high net worth individuals, a lot of like wealth management groups and stuff like that. But then have actively started on reaching out to institutional investors, which it's a matter of networking, participating in more events. I know post-COVID it had been like a little bit, iffy, but there's a lot of like face-to-face events. I trust and believe in face-to-face 100%.
Me too.
And it's a matter of like building upon the relationship. It's not, an investment, regardless of the amount. It's based on trust. So it will never be one call, you got it, and that's it. It's just staying true to what you're doing. Call back, follow up, make sure everyone's comfortable, understanding what you're doing, and
Hmm.
consistent. That's I think one of the keys, consistency.
Yeah, and you're playing the long game, like you said. It's not. And maybe they don't do this one, but maybe they'll do the next one or the one after that. So you just keep doing what you're doing.
That's 100%. And to that point, actually, we've had a lot of investors that wouldn't come in the first round. It had nothing to do with trust. It's just there's too many variables. First is trust, understanding, learning about your company and the industry and the asset class, and then having the funds ready or available. So you can have all the boxes checked already, but if at the time the funds are not available, then it will be later on. But as you mentioned, it's a long-term game. Just stay on it and consistent once again.
Yeah, exactly. Okay, cool. So then, as you're kind of analyzing these deals and putting it all together, what's your exit strategy on these? Because I know some funds they're kind of like flip. They want to be in, they want to be out, and then some funds are really kind of let's bake this thing over the long haul. How do you guys approach that?
Great. Yeah, so right now we're looking at 80s vintage and newer properties wherever we can find like an actual value add approach. Value add meaning any kind of renovation, whether it's interior, exterior, or both, and where we can see like either a proven concept on that rent bump, or just it's clear classic deal that you can renovate and get there. We usually structure to a 5-year hold period with, a after stabilization, maybe like a refinancing, depending on what kind of debt you put in starting off, or a supplemental loan. That's usually like what we structure. We're not the flipping kind of group that gets in and out in a year or in 24 months. We believe it's, we also want to, build community. And I think, short-term managers it's tough with whoever's living at the property, and we try to be respectful with it's people's homes at the end of the day.
Yeah, definitely. So it sounds like you guys have the value add approach over the long term. Why don't you talk about kind of how a deal like that breaks down? Like, and it doesn't have to be specific, but you'll look to buy a property at X, put X amount into it, hold it for X period of time, and then sell it for Y.
Of course. Yeah, so and I'm going to talk about it like what we're seeing recently, right? Because there's been a lot of conversation, I guess, like back and forth in terms of like negative leverage, positive leverage, neutral leverage, whatever. We're not so, I guess we're agnostic in that sense. So we'll be comfortable with in our market buying at shy of 6% cap rate, which represents a negative leverage, as long as we can see a true renovation path. So we'll solve for 10 to 15% rent increases with a capex that represents somewhere around 12 to 15% renovation ROI. That's usually, if we're buying, let's say at 150,000 a door, we're putting in all in, let's call it $15,000 to $20,000 per door, solving for that 15%, 12 to 15% rent increase, and stabilizing the property. Obviously, there's a lot of management in that phase, which is usually between 12 to 18 months of renovation that goes on. Stabilizing or expanding that cap rate from that, call it 5.75, 6-ish to a 7.25%. And then in our market, depending if it's Metro Atlanta or closer to urban, or if it's a secondary market, then solving for an exit anywhere between the 5.5% and 6%. That's basically what we're solving for.
Okay. And over what period of time are you guys looking to do that generally?
Generally 5 years. 5 years. Yeah. So if we stabilize at some point in between, let's call it 24 to 36 months, we can refinance or have a supplemental loan, as I mentioned, have some partial cash out for investors to have part of their investment back. And then in year 5-ish, depending on how market flows, we can exit.
Makes sense. Cool. In terms of all of your planning and stuff like that, how do you guys factor in how the market has changed over the last couple years? How do you guys look at that?
Yeah, I mean, definitely a lot of changes, and 21 and I guess 22 and 23, excuse me, were rough years for operational challenges as well as projecting challenges, because we came from a 2021 with double-digit rent growth, and a lot of people just thought that would keep going for a while. A lot of cap rate compression, and then not a lot of management in the property. So when you come from that kind of environment and then get to today's environment, which a lot of people would say it has changed, and multifamily or real estate crashed and whatnot, but we see it more like we're back to normal, right? And when I say normal, is we're back to managing.
Yeah.
So if you are projecting reasonable numbers, and you're I guess anticipating and underwriting reasonable expectations, you should be fine. I think we're getting into a new cycle, which will come with a lot of opportunity. And what we believe, honestly, as long as you're in a good property, good bones, there's always going to be opportunity. It's always a good time to buy, as long as you're underwriting correctly. When I say correctly, it's maybe conservatively, and not getting ahead of yourself on that.
And really just making sure the cash flow of the property covers everything, because in that situation, you just hold it and you ride out any market.
Exactly. 100%. So, in the kind of market we used to be in 21 and 22, where, interest rates were, floored. If you assume that was going to stay that way, for years, then probably you're going to be in trouble. If you underwrote and got into deals that way, probably so. So as you mentioned, as long as you're cautious with your cash flow, you should be fine.
Awesome. I think you cut out there for a quick second. So if you just want to repeat that last thing you said there.
Okay. Yeah. Sorry about that. I was saying that, as long as you don't get too much ahead of yourself in terms of debt, over leverage, and then maybe assuming that, rates are going to stay floored if you're getting into a bridge loan, for example, and making sure, as you mentioned, that, your income and your projections in rent are covering for all expenses, including debt. If you have it, you should be fine.
Yeah. Yeah. Great advice. So a couple questions I like to wrap up with. One of which is just advice you would give someone looking to start their own fund and go down this journey.
My advice to that, I always say, like, do it as soon as you can. It's never late, and it's always great.
I love that. And in 60 seconds or less, what does it take to be a successful, you know, real estate developer, fund manager, whatever we want to call this role?
Of course. Yeah, I mean, that's a great question, and you can go as long as you can with it. I just say, you got to do it at like you really mean it. You got to trust yourself, trust the process, and enjoy the ride. That's all I say.
There it is. Love that. Very cool, Daniel. Well, for anyone that wants to learn more or connect with you, how can they go about doing that?
Of course, and thanks for that. Our website is apexinvestments.us. Visit us and reach out whenever you want. Whether it is you're interested in investing or if you need any advice. I mean, we're here to help. I believe it's a community game. So anyone that wants to hear more about us, happy to chat and connect. And LinkedIn, Daniel Angel Mejia. And my email is dangel@apexinvestments.us. Feel free to reach out whenever you want.
There you go. Find him, or if you're interested in investing, make sure you connect with Daniel. As always, if you have any questions, just put them in the box down below. We'll reach out on those and circle back. And as always, if you like money and you like real estate, this is the show for you. Hit that subscribe button, and we'll see you on the next one.